Hello, I'm Jay Shashvalya from MFSavings.com. In this clip, we'll try to understand how to calculate capital gains and what is indexation. But before, we need to know what are capital assets. Capital assets are the properties which can be held by a person. Some examples are real estate, shares, mutual fund, gold and debt funds. Fixed deposits and other income instruments are not part of it. Now let us know how to calculate capital gains. Most of the people think that capital gain is equals to selling price minus purchase price. But this is not so. Actually, the real formula is capital gain is equals to sell price minus index purchase price. Now the next question that comes to our mind is, what is index purchase price and how do we calculate an index price? For that, we need to know what is indexation. Indexation is a technique to adjust income payments by means of a price index in order to maintain its purchasing power of a public after inflation. We must understand that prices in general also rises, so the actual price should not be used while calculating the profits, whether it should be indexed as per inflation of the country so that people can get the real value from the sale of the assets. Indexation is used for treatment of debt funds, gold and some other asset class. Now let us calculate the index purchase price. Index purchase price is equals to purchase price multiplied by CII of the current year divided by CII of the year of purchase. Whereas CII is cost inflation index, which is declared every year by the government. It is a measure of inflation that finds application in tax laws while computing long-term capital gains on sale of assets. Once you have index purchase price, you can subtract it by selling price to calculate the capital gains. For some asset class, long-term capital gain is 20% with indexation and 10% without indexation. The cost inflation index or CII declared by Government of India in different financial years is shown here. It started in the year 1981-82 with 100. Let's take an example. Let's assume an investor invested rupees 1 lakh in a debt fund on 1st Jan 2013 for 3 years and withdrew the entire amount along with the returns on 2nd of Jan 2016. Let us assume the maturity value is 1,26,000. Now, in order to calculate the index purchase price, we need to know the CII of the year of purchase, that is year 2012-13, and CII of the year of sale, that is 2015-16. In this case, the capital gains comes out to be minus 877.93 rupees. As there is no capital gain, long-term capital gain tax will be 0. Although the investor earned 26,000 on his investment, he didn't have to pay any tax on it. This is the reason why debt funds are tax-efficient investment product. Mutual fund investments are subject to market risks. Please read the scheme information documents carefully before investing.